You hit on one really interesting point, because when we speak to either individual clients or 401k clients, you often see index funds within the 401k chassis for fixed income. And we're a big proponent of active. Can you walk through where some of the value adds are, and then as we get into these situations where you mentioned where the government's not necessarily going to come to help right away, what kind of risk measures that one might take when they're looking at more of an index in the fixed income space versus that kind of active strategy?
Yeah. Yeah, I think, in fixed income, just the way the fixed income markets are built, the way that they trade, the way that the indexes themselves are constructed in the fixed income or bond world, I think really sort of skews the game in favor of active management over passive. And here's a real quick sort of example. You look at a large, systemically important bank, since we're talking about banks, such as somebody like JP Morgan. They have one equity, one stock ticker. So if you are questioning whether or not you want to own JP Morgan, you can sort of decide, do I want to own the stock or not? And there's hundreds of sell-side analysts producing research and telling you sort of their opinion on the stock and what the stock is worth and price targets. There's a lot of transparency there in the equity side and the stock side. But JP Morgan may have more than 2,000, sometimes close to 3,000 different fixed income instruments at any given time that are benchmark eligible.
Yeah.
And so if you decide that you want to own JP Morgan and you want to buy their debt, you've got thousands of options as to how you take that, where you take that. What is it on the 3-year spot on the curve or the 10-year spot? Is it fixed rate or floating? Is it in the dollar or the euro, right? There's all these combinations. And there's not hundreds of analysts on every one of those securities kind of spouting their opinion about fair value. So it skews the game in that active managers can pick through all those options and find, fixed income securities that they think are underpriced, that you're getting paid, a disproportionate amount to take that exposure, as opposed to sort of owning a stock or not. So that's one example of many that we could give, where we think that the bond markets, by their very nature, give us some of that opportunity. Similarly, sometimes it's just not owning something is a huge value add, right? When you buy a passive product, you sort of get the full basket, whether you want it or not. And if you can just sort of look through and say, here are a few that I don't want. We just talked about CMBS or commercial real estate. There might be some properties that maybe are going to have more challenges and you don't want to own. If you can just avoid some of those, that's a big value add, a big addition to the potential for total return for investors, and sort of a mitigation of risk and volatility, which we think is really important. Because when most investors think about fixed income, they think this is more of a conservative portion of their portfolio. They're not looking for mass volatility there. And again, that's why 2022 was so challenging, because that's precisely what happened, right? You had this, again, no air in the balloon. You didn't get the buffer. The massive move higher in rates meant that prices went down. So you sort of had a very, very difficult recipe last year. But now I think that the all-in yields are much more attractive. The opportunity to provide higher levels of income and to act as that buffer against other risks is just much, much higher for fixed income broadly. And so we think there's good opportunity here. But again, I think from our view, the full risk wave, the full cost of what's happened from monetary policy tightening and recessionary risk has not really gone through, right? It hasn't sort of rolled through where you can just sort of throw a dart and you're going to see awesome yields and awesome total returns, because that spread will collapse and your price will go up and you can sort of go to sleep. In fact, I think it's more of a game of, there isn't much that's sort of obviously cheap. And so you're sort of picking through what's a way that we can really diversify that portfolio, spread those exposures around, and give ourselves or the portfolio a lot of options. Because after some of those risks go through, right, prices get better for us as buyers. We'd rather just buy then, as opposed to being stuck, with big concentrated bets. So our sort of positioning in portfolios today, and what we're watching for is taking advantage of fixed income, being invested, I think being invested in a point where if maybe you were in, you know, a 60-40 or a 70-30 equities to fixed income investor sort of prior to, you know, years ago, this is a good time to get back to those target allocations, because I think fixed income broadly is more attractive now than it has been for many, many years. But taking that diversified approach, having lots of options, lots of exposures is better, in our opinion, than trying to pick one big bet or one sector where you think this is where we're going to hang our hat and where everything's already okay. I think that's going to be key for investors.